Here I am with Kamala, by the way, who I agreed to debate because I love to debate and I'm a very good debater. I love to debate.
That's debatable. Okay, very debatable.
What are your thoughts on the price of living?
You know, the prices, they're very unfair. They're very nasty. When I'm president again, we're getting rid of the prices. There will be no prices.
You would get rid of
And
it.
we'll say, some people, the Democrats, they say the price is right, but it's very wrong. It's very wrong, and we're getting rid of prices, and we're giving away a lot. We're giving away vegetables. I'm starting a garden, a very big garden, and everyone can have a pumpkin.
Okay, you know what? We're not doing pumpkins, okay? In my policies, we're giving away tomatoes, okay, carrots, all right, cucumbers, all right, for everybody, not just one side, because there's the right and then there's the left and then there's everybody in between.
You know, there's the right side, then there's the wrong side, and Kamala, she's in over her head. Look at her, by the way.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and guys, a very mixed day. There were winners, there were losers, but a volatile day of trading. This heat map doesn't give the full picture of what today was, but at the end of all of it, stocks actually ended lower on Wednesday. It was a volatile session after the Federal Reserve lowered interest rates by 0.5 percentage point. That's 50 basis points, guys. And pretty much the Fed trying to get ahead of economic weakness as well as normalize the policy a bit further. In light of all of the news we got today, and we saw outperformance here in Apple, but the majority of tech actually sold off. Google Meta fared pretty well. We saw defensive sectors sell off, stuff like utilities and consumer defensives, but there wasn't much of a trend of anything. The only green sector today was energy, up 0.2%, mostly on the back of the price action we saw in oil. Other than that, every sector was in the red, with technology being the worst, down 1%, bringing the entire S&P 500 down with it. And it wasn't just large caps though. We saw selling in mid caps and small caps. However, value and core in the small cap segment were actually okay. They were green, up 0.25, 0.13 respectively, with large cap growth getting hit the hardest, down 0.74%. And it wasn't just the rate cut decision that spurred on this volatility. We also got the Fed's economic projections, and the Fed's latest summary showed the majority of Fed officials expect the central bank to cut interest rates by 100 basis points this year. So that pretty much means in the next two FOMC meetings, we're probably going to get 225 basis points worth of cuts, and the Fed will just probably front loading a 50. And in Jerome Powell's speech today, he came out and he said that he wasn't seeing any major deterioration in the economic fundamentals. He pretty much assured investors that this 50 basis point cut was really just to normalize policy and just to get things rolling versus economic concerns. But the market didn't really believe him because yes, we did rally on the news that we were getting 100 basis points worth of cuts through 2024, or at least that was the projections. And we pretty much went from being flat here on the day to the IWM up 2.68%, the major indices, the RSP, the S&P 500 and the Nasdaq 100 up more than 0.5 percentage point at its peak, in some cases nearly 1%. However, we paired all of those gains in the Russell 2000 and all of the majors, and the Nasdaq 100 was actually down 0.58%. And this was just a momentum trade. It was a sell the news event. The market had rallied a lot up into this peak right here, but also it had rallied into these rate cuts in the week prior, coming off the lows we saw in early September. And we actually did finish red on the day. We also got a couple of other data points that did support the economic picture. We got building permits and housing starts. Both came in better than the forecasts, 1.36 million in housing starts versus 1.31 million. And then building permits, which is actually a forward indicator because building permits determine how many housing starts were actually going to get 1.48 versus 1.41 million, but it didn't really move the needle today. Everybody was really just waiting for the Fed's decision. We got the 50 basis point cut, and then we bought the news and sold the news in a single day. And in volatile trade like this, both the bears and the bulls were caught offside. The real winners today were those that were already positioned into these rate cuts weeks and months prior, like many of you were on this channel. And there was some very weird price action that went on. Everything was red except for the IWM small caps, the SP 600 and mid caps. A pretty red day across the board. But what's really weird is that the 2-year yield, 10-year yield, and 30-year yield gained on the back of rate cuts. So the market is telling us something there. Maybe the bond market or the credit market is not quite happy with the Fed's economic projections, and that's why we actually saw yields rally. Bonds sold off as a result. Gold and silver were actually down in light of rate cuts, meaning that a lot of this move is already or was already priced in. Silver fell 2%, gold down 0.5 percentage point, Bitcoin was largely flat, and the dollar, very volatile move in the dollar. Look at this, it really just came off its lows, and I think we are going to see a little bit of strength in the dollar. But looking at the S&P 500, and guys, firstly, the advanced decline line did tick down ever so slightly, so breadth wasn't that great, but one day's worth of breadth isn't going to derail what we've seen for the better part of the last year, especially with this broadening out. But the gamma flip zones, guys, have not changed, meaning that 56.75, the core resistance, acts as strong resistance, and that's exactly what we saw today. On my weekend video, I said that the Fed decision was likely going to be a sell the news event. We actually had a lot of confluence with the core resistance leading up into this, and we saw a bit of a pullback. I said yesterday risk was asymmetrically skewed to the downside, and that's what we're seeing. And until the core resistance actually moves up, which it hasn't, I think we're going to probably make our way to the 55.50 area and have some price discovery right here. Not a bad thing. You want to buy the dip because stocks do very well in environments where there's no recession, and I'm just not seeing a recession, especially with the data we got at the start of this week with retail sales, as well as the building permits, housing starts data today. I just don't think I'm seeing a recession just yet. Things can change, but you do want to buy this dip, but we are in a volatile time period, that being September, and that can go through to as far as late October, maybe even early November, especially with an election looming. But guys, with the core resistance having not moved up, risk is still skewed to the downside, and I really want to be a buyer of dips here at this 55.50 area. That being said, I am bullish longer term because we just made an intraday all-time high. We made one yesterday, we made another one today. We actually broke above the core resistance, guys. That is bullish, new all-time highs. There is nothing more bullish than that. But in the short term, we can see a little bit of downward momentum. Now, I'm not saying we're going to pull back to the 55.50 area. We can pull back from here in between this area. I'm just saying that until the core resistance actually moves up above the 56.75 area, we can see very volatile and choppy action. However, in the after hours, the IWM, the Qs, the SPY, and the RSP are all up 0.21, 0.18, 0.13, and 0.2% respectively. So we could actually see some upbeat action overnight, and we'll see how the markets respond to the Fed's rate cuts globally. Looking at the Nasdaq 100, down 0.54% today, still in positive gamma. The gamma flip hasn't moved. We did put in a lower high right here and a higher low, so very mixed trading action. What we really want to see the Nasdaq do is either take out this high right here or this low, and that will then mean the trend is back on. Ideally, we want to take this high for more upward momentum, but the market can stay irrational longer than you can stay solvent. Looking at the RTY, very constructive. We see very constructive things. Number one, the gamma flip zone for the RTY actually moved up from 21.25 to 21.50, meaning there were more bullish bets being bought in the options market with regards to the Russell 2000. Also, we did go ahead and wick above this high right here. It wasn't just the close, we wicked above it. So this is actually a trend continuation. We put in a low right here, a higher low, and then we actually go ahead and make a higher high on a wick basis. That's very constructive. That means we can then see this level right here, assuming we hold this low at the 2080 level. If the Russell 2000 is to pull back, ideally we stay above the gamma flip zone, find support, and then make a move to the upside, breaking this high right here, that would be very, very constructive. This, by the way, is a 52-week high. If we go ahead and do that, it opens up all-time highs. So the Russell 2000 looking very, very constructive. Same with the RSP. I mean, that's another week new all-time high. We didn't get a closing high, but super, super constructive price action in the RSP. You really want to be positioned in something like the Moat Index, the CAF Index, or the RSP right now. And you do want to buy any dips we do get in the market cap weighted indices, because I do think the AI trend is definitely something that we do want to be a part of. You want exposure to technology because that trend is going to stay intact for a good couple of years. We're just in a consolidation period here. Looking at some of the other names I hold in my portfolio, guys, PayPal did very, very well today. PayPal was up 1.88%. If we go on a year-to-date percentage return basis, up 19% for the year, nearly at 52-week highs, and it completely outperformed the market here today. Looking at Paycom, another key holding in my portfolio, it hasn't done that great this year. However, this is where I actually bought. My average buy is about 142 in Paycom. The actual price right now is about 170, and it fared very well today, up 1.12%. Looking at Google, one of my other positions, something I said to buy, I actually bought Google right here. I'm in at about 153. That's my average buy for Google. It actually did very well today. It was up 0.33%, again, outperforming the Nasdaq 100 and the S&P 500. So if you guys are looking to add single stock exposure, look at Paycom, PayPal, Google. You have an industrial stock there, a financial stock, a tech stock, or communication stock in stuff like Google. But if you are looking at ETFs, look at the CAF Index, QSML, MOAT, MOAT, or the RSP. That's where you want exposure right now. And if you do want to diversify your portfolio, I think maybe don't add to bonds, add to something like gold. I think gold can see outsized returns. I think we can see 2,700 gold by early 2025. But at the end of the day, guys, looking at the S&P 500, just to wrap up the charts, expect more volatility through the end of the week until the gamma flip zones change. Right now, it's telling us that we are going to see downside to the 5550 area. But if we do get a move up in the core resistance, that trend could change. But for now, sit through the volatility and have some cash ready to buy the dip in this volatile September period. And looking at sentiment, CNN's Fear and Greed Index, and for all of the drama we've had in August and September, we are sitting on the border between neutral and greedy. I mean, we've gone from greedy to extreme fear, back to extreme fear, now in neutral, almost at the greed zone, all in the matter of about 4 to 5 weeks. It's been a very volatile time in the last 4 to 5 weeks, and do expect that volatility to continue because we are entering one of the most treacherous periods in September. This is S&P 500 performance from September 19th to September 26th in the last 50 years. And this time period from tomorrow for the next 6 trading days has only seen 16 up years, 34 down years with an average return negative 0.99 or 1%, median change down 0.6%. And you can see 1% up moves, only 7, 21 1% down moves out of 50 here, guys, and 3% moves, 0 for 9. So in this period, if we see a massive move, it's probably gonna be to the downside regardless of rate cuts. This is what seasonality tells us. And if we go to a time period like 2019 when we were getting cuts, you could see down 0.97%. If we look at a time period like 1997, this week was red as well. 1995, we were getting rate cuts in a similar fashion, down 0.48%. So guys, do expect volatility in the next week of trading, but volatility is simply the price we pay for outsized returns in the market. And part of the reason why we've had a lot of volatility is because the long Magnificent 7, which used to be the most crowded trade, has started to unwind. Now, in September 2024, it is still the most crowded trade. However, we have seen that pull back, and we've seen stuff like long gold come back into the fold, as well as short China equities. So we've seen a little bit of a rotation out of the Magnificent 7, and we've seen participants get into stuff like bonds, short China equities, and gold. And by extension, this has led to a broadening, and it also is going to lead to volatility because you're essentially actually selling the biggest stocks in the market, the stocks with the most weight, and that is going to bring volatility. And it just so happens to be in the most volatile time period in the year, October, August, and September. And we are officially in a cutting cycle, guys. Jerome Powell cut rates for the first time in 4 years, and we're going to dive into what normally happens to assets after the first rate cut, and then look at asset prices 1 month, 3 months, 6 months, 12 months down the line, because we have some fantastic data here to get into. Now, looking at equities, stocks in certain years, the state of the economy is an important factor to consider, guys, when we gauge stock performance going into rate cuts. You can see that if we cut to normalized policy or panic cut, stocks tend to do very, very well in such environments. We could see average returns of about 5 to 10% right here. In a panic scenario, we actually get outsized returns upward of 20%. However, if we do enter a recession, things do get grim. We could see 3 months, 6 months down the track, we can see declines upward of 15% very, very quickly. However, those losses do tend to normalize 12 months later. That being said, we definitely don't want to go into a recession because stocks don't do well in that type of environment. Now, the S&P 500 has been 6.6% higher after the first rate cut. Consumer staples and consumer discretionary had the best performance, both rising around 14% a year after the first cut. Healthcare rose 12% and technology rose 8%. Small caps, which are seen as highly sensitive to an economic turnaround, also outperformed. The Russell 12 months later normally returns about 7.4%. And stocks typically have dipped going into a rate cut 1 month and 3 months before a Fed cut. Almost every single sector saw a dip of at least 1 to 3% leading up into this cut. However, every single sector was positive 6 months thereafter. So we can actually see a little bit of volatility following this first cut, especially 1 month, 3 months after. But things look very, very good 6 months onward. Bonds have been a very rewarding bet for investors at the start of rate cutting cycles. This time, however, bonds have actually ripped up. We went in the last 3 months from $88 in the TLT to about $100 right now. So a lot of the move has already been priced in. Treasuries have seen a huge rally. And what this data set tells us right here is that we could actually see outperformance 1 month, maybe even 3 months later in treasury bonds. But 12 months later, generally speaking, we actually see yields rise after the first Fed cut, and the average yield climbed a median of 59 basis points a year after the initial cut. So if you are holding on to bonds, maybe use the next 1 to 3 months to maybe scale out of that position and maybe put it into stuff like equities if we do get a dip in that same time period. The greenback strengthened a median of 7.7% against a trade-weighted basket of currencies a year after the first Fed rate cut when the economy was not in a recession. However, it only increased 1.8% when we were in a recession and actually traded largely flat. At the same time, the dollar tends to outperform other currencies when the US cuts alongside a number of central banks, according to a separate Goldman Sachs analyst note. So we are going into a global cutting cycle. A lot of other countries have already started cutting, and technically what we can actually see is the dollar strengthen, but not without volatility first. As you can see right here, we normally actually pull back when we don't get a recession. In fact, in both instances, recession, no recession, we actually pull back quite significantly, might I add, and then we continue the move higher, and from there, we actually either trade sideways in a recession or we just move higher without a recession. Diving into the macro, which is so important right now, because how the economy holds up will determine the path for stocks and the financial markets and where we go from here. And right now, economic growth still looking good. The Fed's GDP now tracking for the third quarter is at 3%, up from 2.5%. This was on the back of the robust retail sales data we got earlier on in the week. Things were looking rather shaky here, but at 3% growth with real rates this high, this is absolutely fantastic. And rate cuts should continue to spur on growth. If anything, keep growth where it is, and that's between that 2 to 3% range into 2025. At the same time, consumers are looking very strong. Weekly credit and debit card spending data shows the consumer is hanging in there and actually increasing their spending over the last year. Now, many people will argue the point that all of this is being put on credit, but the data doesn't support that. Household debt service payments as a percentage of disposable income is sitting at about the 9.7 range right here. The pre-pandemic average actually is about 10. This data only goes back to about 2019, but the pre-pandemic average is about 10%, and we've actually seen this figure fall in recent months. So the consumers hanging in there, they're not using a whole bunch of their incomes to service their debt, and growth looking good for the third quarter. This to me signals a strong economy despite where real rates are right now. At the same time, yield spreads aren't signaling that there's a pending recession. This is the spread between AA corporate bonds and US Treasury bonds. AA corporate bonds represent the safest companies out there, and when their spread narrows, it shows investors aren't asking for much more return to take on corporate risk. Low spreads signal high confidence in corporate stability. When spreads are this tight, guys, in a high interest rate environment, it suggests investors still see corporate debt as a safe bet despite rising costs. It also signals confidence in corporate balance sheets and earnings resilience, and by extension, a resilient economy. The credit markets are not concerned about a recession, and in my view, I am not either until this changes. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.